All right. Mentioned already, I was on weekend at a conference, and I was not aware that the last bit of interaction at a conference. No problem. It's called the Great Large Shift, and it has obviously a sort of a more negative connotation. When we designed the program, we wanted to make sure that we leave one highlight at the very end, and we couldn't have not thought of a better highlight than Steffen's with his co-authors work on the repo market, because Steffen is one within our YSR community, one of the actually also working forces who do a lot of research in liquidity theories or money view, and I've learned already a lot from his research. So with that, let me introduce Steffen and sort of say the last interaction for today on the research side. Steffen is a research group leader at the Global Climate Forum in Berlin and Freie Universität Berlin. I think that's something that we have recently acquired for 6 years. He's also affiliated with the Global Development Policy Center at Boston University, where Merlin is also associated with. And Steffen holds a PhD in International Political Economy from City University of London. And with that, we're looking forward to what you have to say in the first years.
Thank you. So welcome everybody to the Great Large Shift. Let's hope it's going to be sufficiently interesting, and then we look all forward to enjoying the rest of this beautiful day. So the paper I present is called Encumbered Security, Conceptualizing Vertical and Horizontal Repos in the Euro Area. And it is a joint project with Alex and Matteo, 2 PhD students. And so this paper is basically a note. So this is listen to me.
Somebody else's.
So we work. There's a bigger research project that aims to think about the world as a web of interlocking balance sheets that I've been working on for a couple of years now. I was actually hoping to be done with it by now, but it's thought of as a trilogy. I will show it in a moment. And so we're working on the third part of this trilogy. And the idea is to basically show in interlocking balance sheets the dynamics of the Eurozone crisis. Basically, first map the global financial crisis, show contraction and elasticity dynamics in like a big balance sheet figure, and how the global financial crisis spilled over to the Euro crisis, and basically show the logic of actually what was going on there. So it's, on the one hand, it's a very high level idea, right? So the idea is really to show how the dynamics of the financial cycle basically lead to institutional transformation. That's maybe the theoretical idea behind this, but then also really zoom in and be very nitty gritty and show what these dynamics were. And to this end, you have to understand how the repo market works, right? So the idea is really to integrate repos in a wider story about monetary transformation. And to this end, you have to be able to put repos on balance sheets, right? So because it's thinking about webs of interlocking balance sheets. And we were struggling to achieve that because we had disagreement on how to conceptualize repos on balance sheet, right? And so we, as co-authors, we had the impression to be talking past each other, and we looked at literature, we looked at different ways how in the current discourse repos are being conceptualized. And we found it insufficient, right? Because for what we wanted to show, and the key example is, I don't know, contraction on Greek treasury balance sheets. How does this spill over through banks and non-banks in Europe on cross-border on balance sheets? But to this end, we need to know something. So where, when we conceptualize repos, where's the security, right? And so does repo come with money creation or not? So there's a big literature on shadow money, and they say, so repos are forms of shadow money. In order to show that, you have to be able to get the balance sheet straight. And we had the impression that actually the balance, so in the existing literature, the balance sheets are not, so we're not really there yet. And I tried to, and from this problematization, we first thought, oh, why don't we write a blog post? And then things became more and more complex. And we tried to, so we had an idea for reconceptualizing repos in mind and tried to connect it to empirical empirical data that is out there. And the whole thing turned basically into a working paper, which is currently under review at INET. And then if that goes through, maybe we'll make a journal article out of it later. But so I'm very happy to be able to present it here and also discuss with Repo practitioners on, yeah, if this resonates and if we can find some common language here. Usually balance sheets promise to be a common language. So there's, but we already started the conversation, I guess. So this is this trilogy which I mentioned. So it's about, first one is about the macro financial model of the Eurozone architecture and the global dollar system. And the second one, which really zooms out even further on the international level. And now we're talking about a paper that is called Transformation of the Eurozone Architecture, and which got derailed by the fact that we didn't know what to do repos. So I read up a lot about the history of repos. I mean, there are stories that they date back until early modern period. But then when you look at the US, it turns out that the first time when the repos were really used was in the First World War. The Fed had just been founded, and the US Central Bank wanted to support war finance activities of the Treasury, but according to the recent statutes, it was not allowed to, because it was only allowed to interact with member banks of the Federal Reserve System. And there had to be, it was necessary to find a way how it was possible to extend credit to banks and fund the expansion of Treasury debts, which did not violate the Fed's original mandate. And the idea of the repo is, well, it's constructed as not lending, but a sale and repurchase. So it basically comes with an inherent ambiguity. And so our hypothesis is that this inherent ambiguity has been there from the start. It's probably also a bit on purpose, and it continues to challenge us when we want to think about repos as a financial instrument, in particular when we want to understand the euro crisis. And then another challenge that we found in the literature about the European Monetary Union is that there are basically two types of repos. The ones that are used as a monetary policy instrument with the euro system, and then private repos between banks mainly. And they are usually treated as the same instrument. And so our claim here is that they're basically not. And we want to show with balance sheets why it makes sense to actually think about two different categories of repos here. Now, how should we present them on balance sheets? So the big challenge, or the underlying problem that we're dealing with here, is that we say there is so far no clear notation style out there that shows simultaneously the creation of a repo IOU, the potential creation of traditional money in the form of deposits and reserves, and what happens with the security that is used as collateral. So, and I mean, the literature that we speak to would be mainly Merlin, Pojar, and Gabor, for instance. And they all have their own ways how they're represented, but there's always one thing missing. So Merlin, for instance, shows how the Fed issues a repo with a dealer as counterparty, but you don't see the security that is used as collateral. Pojar just writes here these repos as overnight repos against each other. And then Daniela Gabor tries to bring in the creation of repo. I think when she writes here shadow money, she means the repo IOU, and tries to show with like some arrows what happens with the collateral, but we also have the impression that it doesn't really fully add up. So we want to come up with a notation style that is capable of making all these things, all the 3 points. So, and we basically have three conceptual claims now on for how to think about repos. And the first one is, as I said, repos are actually two instruments. There are vertical and there are horizontal repos. And the difference is if the two counterparties that make a repo are located on the same hierarchical level within the hierarchy of money. So same hierarchical level would be two banks, for instance, or on different hierarchical levels. For instance, central bank and bank. So if they are on different hierarchical levels, then it would be a vertical repo, same level would be a horizontal repo. And the difference we can see in the balance sheet, because so if the central bank has the bank as a counterparty, the bank will issue a repo as a liability, which the central bank holds as an asset, and the central bank creates reserves, which then the bank holds as an asset. So this is in this money view literature, you would call it a pure swap of IOUs. So here we see traditional money creation of reserves. But if we have two banks that are counterparties, There's no reserve creation taking place, but a reserve that Bank A already had in its asset book is just rented out. So it's a different type of operation. So the first conceptual idea also to clarify how repos in the euro area work, make a difference between vertical repos, which are a monetary policy instrument in Europe, and horizontal repos, which are secured interbank lending. And the second question is what happens with the collateral, right? So how can we what should we do? What's going on with this collateral? And the regulation is that the collateral is encumbered, right? So, and what does it mean that the collateral is encumbered? So there's a legal treatment which says that, well, it's the sale and repurchase of a security at T0 and T1. In the euro area, this is treated from a legal perspective as the outright sale of a security. In the US, it's treated as collateralized lending, which leads to certain different legal discourses about the whole process. But if we write it like this, which is clearly not the way how it's being done, we don't see how any repo IOUs are being issued. So the accounting treatment that we suggest is here now for a horizontal repo, that we not only show the creation of the repo and what happens to the reserves, but that we also show in a parallel booking what is going on with the security that is used as collateral. And the way we suggest to put it is that it is shifted on the repo borrower balance sheets from being held outright to being encumbered, so which is an asset swap. And then that there's an off-balance sheet position of the counterparty that then holds the security which is pledged as collateral. So this is the second step to how we argue that if we think about repos like this, then we at least know what's going on with the security, right? So the question is if it matters, right? But I guess at some point when you want to understand crisis dynamics, it's really important to understand where is the security that is used as collateral during the time of the until maturity, right? Which is just not clear in the existing notation styles. And so we claim that this would be a notation style that is able to reconcile the accounting and legal practices. And then the third step is, because this is also relevant for our case study on Euro crisis dynamics, that so existing notation styles don't tell us anything which securities are eligible as collateral. And the main tool of the Euro system to deal with with like contraction dynamics on the repo market was to change the list of eligible collateral, and there's so far no way to represent this on balance sheets. And that's why our idea is so that we can basically show within a balance sheet methodology what changes over time, so that we basically have when we look now at vertical repos between central banks and banks, that we integrate the collateral framework with this notation style on the balance sheet. I would say so there's a position repo on the central bank balance sheet with a list of eligible collateral, and then we can list sort of the securities or the rating of the securities to basically show what happens actually when the collateral framework is changed, which is like a key crisis mitigation mechanism. Yeah. So those are basically, so these 3 points are really the key argument of the paper. So distinguishing horizontal and vertical repos, showing what happens to the security which is booked off balance sheet, and then integrating the collateral framework. I'll speed up now a bit. So we try to show in the paper that this can be actually reconciled with the way how the data recording takes place, right? So we can see when we look here for vertical repos between banks and the Euro system and the data that the ECB publishes, where the repos are booked through different monetary policy operations, and we see where the outright securities are held. So it's a way to basically reconcile this balance sheet methodology with the existing data that is being published. This gives an overview on the expansion of repos. And I mean, the implication here is that we say if the ECB does outright asset purchases, the balance sheet increases, and the assets the Eurosystem purchases are on the Eurosystem balance sheet, and if it's done with repo, they are basically on an off-balance sheet position. So which still helps us think where the security actually is. The fourth point would be then that we use this methodology for showing collateral frameworks to really sketch how the transformation of both CCP balance sheets and Eurosystem balance sheets have taken place over time. This is just a way of then really mapping the transformation of the Eurozone architecture, which is the goal of the research project. And we can do the same thing for CCPs here. And because I'm running out of time, so the final point is, and this is also a discussion, so how can we reasonably put on balance sheet the reuse of collateral? So in Europe, it's called reuse, right? In the US, it's called rehypothecation, which in our understanding is just because of the different legal treatment of what the repo actually is, right? It's part of the ambiguity that there have been like precedent cases of how it should be treated. And then, yeah, so, but it's if we think about a balance sheet perspective, it's the same. And we end the paper with a discussion of this reuse in the European case. And I guess this is really also where we feel least comfortable, if this is really a useful way to think about it. But the notation style we have in mind is to say, okay, so there's first, so here a horizontal repo between bank B and bank A. And then the security of bank B is encumbered. So it's in this original repo transaction, so which is recorded on balance off balance sheet on bank A, right? But then bank A is still able to create a second repo contract on top of the first one. But where is the collateral still parked? And we think it still makes sense to say it's originally, it remains encumbered on bank B's balance sheet. And the notation style to make this reuse logically feasible is to then say we have a repo on the repo. But yeah, this is really open discussion if this is a sound way to think about it or not. Yeah, this is a bit the intellectual frontier that we have here. Again, the point is to be then able to use this methodology to show in a concise way how the transformation of the Eurozone architecture has been happening at Eurex. Thanks.
Thank you, Steffen. We're now going to move on to how your paper be discussed by two discussants. And I would ask for both discussant, I'm going to introduce both, and then you decide to get this rolling. So for those who, some of you know, this paper was presented online, I think mid-April, sort of to let the community know about this conference. So this, you have already discussed it once, but you have you said it's the notes, you're gonna do it one more time. And so, but Clive has, so this is sort of, but you haven't been there. So
yeah, it's news to me.
Godfried, you need no introduction, but I'm going to still give you one. So Godfried is a senior advisor of the European Repo and Collateral Council at ICMA, which is the International Capital Markets Association, and has experience of 35 plus years in the industry. As I said, we had a chance to dry run this paper with you, and we had found you through the recommendation of Klaus Leber, and you have been very helpful. We think so far. We're looking forward to your thoughts.
Thank you for having me. Because one thing is sure, all the discussion on CCPs will not function without the repo market, because we are the oil to make sure the system works, right? And we discussed this setting up for lunchtime. The merits of this, I think the merits is that finally the academics start to pay attention to the repo market. We need it. But then, although I'm chairing this European Repo and Collateral Council for 25 years, it's still not understood, except for those in the market. Right? And I even question if our regulators and even central banks don't understand the debt on this market. It's a very simple product. It's like your mortgage. You want to buy a house, you give the house as guarantee for the cash that you got to pay for the house building, right? That's a principle. Much more complicated call when you go into it. Now, when the ECB was created, the European Money Institute, they actually created buy sell backs as the instrument to do monetary policy. And because the market was already knowing the repo, they caused also repo. So that's what some of the confusion on the balance sheet treatment, if you want to go in that line. One other thing, there's SFTR has been security finance trade reporting is now gone to the ESMA. The ESMA doesn't know how to treat it, so they have created the data mining now, but there's already a lot of data information. ERC has done for 20 years a 6-monthly repo survey, and we see the evolution of the market. We have seen the Lehman crash, which is not a cause of the fault of the repo market. The sovereign debt crisis was not a fault of the repo market. The gilt crisis in November, October last year was not a repo market. There's other factors, but at the end of the day, the repo is there to help financing all the assets that people need to finance, not only banks, also insurance companies, pension funds, hedge funds, of course, for speculation. And hedge funds are not, in my view, not really all the speculators. They are the ones who recorrect the market when politicians or officials cannot intervene. But that's another discussion for another time. Now, another problem we have, particularly in Europe, is the historical mistake that was made when the ECB was created. They only looked at cash. They never looked at securities. And so we have 30 CSDs, we have 15 CCPs, we have far too much of everything, and they even create more. They have created recently the National Bank of Belgium as the issuing CSD for common sovereign bonds in Europe. And now I get questions, how can we increase the liquidity? And there's so many issues still to be discussed through the Giovannini group, of which I was an early member, with the Commission, banking, CMU, and all that stuff. So the study, in particular, when I read it the first time, can lead to wrong conclusions. So I hope eventually it will widen. To give you an example, it talks a lot about the tri-party product, but there's also a lot of bilateral repo. There's also a lot of use, of course, of repo into the CCPs, which when a bank buys a bond and it's kicked out the bonds for financing, it goes in the CCP for the bank and it's netted, as we heard earlier today. If an insurance company buys, for instance, the common issuance or the bond, it stays on their balance sheet and it's for the benefit of the pensioners. But then when the policy goes to negative, the interest rates go down and then you create other problems, which is not a fault of the repo market. Of course, it's a policy issue that had been pushed. One reference in the study, when you read it, which made me really hot, was the Gordon metric saying the repo was the cause of the crisis. It was not. It was the securitization under it. In America, they gave loans to people who were on the dole, and they had to pay a little bit in the beginning. And as the maturity that of securitization went wrong, they couldn't repay, and then they went in default, and that was the problem. The Lehman crisis. Just a brief word. Lehman was financed in repo till Friday night, when they went west on Monday morning when the markets opened. In the meantime, on Saturday night, ICMA, the compression service, was asked, can you do a compression cycle on Sunday before the markets open, so we have less volume to deal with in the default. At the same time, the banks who do tri-party in the States were exchanging their balances against Lehman, so that was off the balance sheet when Lehman went bust. So repo is a technique that is used day and night and very well understood by those who have to deal with those issues. Another thing that really surprised me, 2 weeks ago, we had Martin Wheatley, the Secretary General from IOSCO, the new one, who said we're going to focus particularly on repo in the next year. Martin, I know you for 25 years. We discussed this 100 times. We discussed 100 times CCPs. Yes, but we need to understand it better because they're in the link of the CCPs. It's a weak issue. For instance, what I heard from CCPs now on derivatives, with regulation. When somebody uses derivatives, there's a certain max minimum, and if you go over the minimum, you have to do mandatory clearing in the future for pension funds. But it's not sure, like in Australia and New Zealand was decided, even if it goes under that minimum, it still needs to go to CCP. But for Europe, we don't know yet. So there is a lot of issues that impact the repo market from the variation margin that we have to provide for the benefit of the financial stability of CCP. Repos on the balance sheet, and I know very well because when Sharon Bowles was chair of the European Parliament Finance Committee, we had a call with her. She was in Strasbourg, I was in Brussels, which was in Oxford. And yes, we need to see more of repo. It is on a footnote in the balance sheet, so people watch that. So that's something that needs to be looked at. Now, there's also a big debate about specials, right? The bond market is special, but yes, for somebody who really likes the strong government bonds of Germany, for instance, it has a special price. But for somebody who needs financing, it's general collateral. So those two terms, so plain vanilla bonds or general collateral, so the price is similar to the money market price, a little bit different. And special or special, but special for me can be GC for you. And that's a confusion that people don't always get around in their head. The vertical discussion, yes. OMO, MROs, LTRO, TLTRO, all those issues that were used by the ECB are tools to help contain the crisis. You know, the TLTRO is being reduced. And what I learned last week in the framework of the common collateral installation by the central bank system is that they reduce, of course, all the corporate bonds, the government bonds. They're looking at the eligibility, but the credit claims for 700 billion will stay on the balance sheet of the ECB given by the commercial banks. This is real economy loans that the ECB is helping to finance. And I know people don't really get it much. When Mrs. Betrude Tumpel-Guggerer was in charge of the markets in the ECB, she told me, Godfried, please give us all the less good quality. And you take the government bonds to guarantee CCPs, to guarantee payment systems, to guarantee the ICSDs. So that is evolving. Now, claims they have a general, they also have national rules. And I remember in the sovereign debt crisis when we were all scrambling for collateral and cash, the Bank of France had decided that credit claims down to 500 euro can be given to the Bank of France. The ECB doesn't take that. That's also changing. So what's important in the future is that you look also at eligibility. Now, what's eligible in the eyes of the market at large? Anything you can price on a regular basis can be used. And of course, you take a haircut, and the haircuts can evolve according to the market conditions. So that's not because the repo is the cause of the crisis. The repo has to manage the risk of the underlying collateral. I have a joke that has been going on for 25 years. There's one collateral nobody can price. The mother-in-law. There's no price for mother-in-law. And I still smile and I talk 25 years ago. Page 3. Yes. So I think for the CCPs, they had an easy job. In a way, they only take good risk. Yeah, derivatives that can be priced. You have an intervention on bilateral that could go to CCPs, but that has not been pursued yet. Another thing is perhaps in the government bonds market, right? Nearly more than 5 years ago. I was involved with the Greek authorities. They wanted to keep the repo market alive. The central bank was agreed with me, the Ministry of Finance, but then one politician in Greece said the central bank is helping speculators in the Greece. So immediately was in the Financial Times, and so the politicians pushed Greece to do mandatory buy-ins, like a bit like in CSDR nightmare. The market collapsed overnight. That was the end of the market. So these are issues that, you know, when you study more and more, you have to be careful. One last thing, and then I back. We also have created, thanks to Jean-Claude Trichet when he was governor of the Bank of France, a bridge to clear BTPs, Italian government bonds, in LCH Paris and in CCNG in Milan. And why was that? This is the biggest collateral market in Europe, because bonds are kept under the sofa, right? BTP, OTFs, the French bonds are also put under the mattress. BTPs are, that is so big, we could use it for everything. The problem was when the crisis hit and hedge funds corrected the price of government financing for Italy, so the market shot up in yield. The Italian CCP only had Italian counterparties, the French only had the others. And the French CCP had 70% of Italian debt on their books. And then you come to the discussion of Romare risk, right? And that's where Mr. Draghi said, we will do everything to save the euro. And, you know, I don't care if it's publicly known. For me, it was always, we will save Italy and then we save the euro. So repo is very useful, very necessary, but we have a lot of work to do. And I think that the job will not be finished in my lifetime to have a harmonized one market, one central bank, one or two settlement systems, but we have far too many. And that's the problem of the repo market and also the protection of CCPs. There's a bit of everything. And it's very difficult to kind of keep your head focused on one thing because there's so many other factors that impact this market. And so I hope there's much more studies coming about repo. And please reach out to the traders or to associations who know this a bit better. We have done so much work with the Fed as well. Many times tomorrow the Fed is there as well. They know the market, but academic circles, it's very, very little literature. So hopefully you can do this in the future.
All right, coming towards the end, I think when Steffen and the court talked to us, they said it's very nice if we could have someone from the clearinghouse also comment on our paper. And so we're very glad that Clive is here today. I'm going to briefly introduce you. Clive works for Eurex, mentioned that already, like Alexander as well. And you work in strategy and initiatives, covering fixed income market structure, financial regulation, and central bank monetary policy developments. In a previous life, you worked in a number of investment banks implementing the Basel Accords, specifically 2, 2.5, 3, and 4, and managing the business strategy under the different regimes. And we're looking forward to what you have to say. The floor is yours.
And it's also very privileged to follow this. Certainly the industry veteran that we all looked up to. And I've learned a lot from over the years. So it's great to see you and listen to your comments on this paper. So first, I'd like to commend Dr. Murau for an excellent presentation. The presentation had a tremendous amount of education value. But before I go further, in my world, in the world that I work in, it's okay to disagree with people. Okay. We can agree to disagree and then go have a beer at the end of the day. Right? That's the world I work in, and I'm hoping it's the same world that you work in as well. So a lot of what was presented by Dr. Murau today, I don't necessarily share the same view about. So, but firstly, I want to start with the topic of asset encumbrance and why it is generally an important topic. So banks, you have to ask yourself a question, why do banks go to the secured market, which inevitably encumbers their assets? They go to the secured market because they cannot access the unsecured market. Then you have to think about the reasons why can't they access the unsecured market. Well, it could be that they're in a country with low credit standing. Okay? So because they're in a country with low credit standing, the rest of the banks in the other parts of the world don't trust them. And that's where the sovereign bank nexus comes into play. Another reason is that the credit standing of the bank itself may be poor. Right? For instance, it could be poor because it has a very high proportion of non-performing loans, or it could be weakly capitalized. So the own credit standing of the bank becomes important as well. And then finally, as Mr. Vidts alluded to, the central banks have been flooding the market with a lot of cheap liquidity using secure funding. And what that has done is that it's increased the asset encumbrance of banks, okay, to astronomical levels. So there's a lot of interest in this topic. So if I could just speak briefly about the last slide that Dr. Murau presented, and this is where I have the big problem, and it was on collateral reuse. And you went through it a little bit quickly, but in the paper that underlies the presentation today, it described collateral reuse as this major problem or a major issue. And I personally don't share that view. Okay, so collateral reuse is a feature of our markets. Okay, that's a pretty important feature. And I grant that it's a feature that needs to be better understood, but I don't share the view that it's a problem. So Mr. Vidts used the phrase earlier, the repo product greases the wheels of the financial system. Who has heard that before today? Okay, show of hands. Yep, most of you have heard that before today. Okay. The reason it greases the wheels of the financial system is because collateral can be reused. If you take away that feature or you start putting restrictions on that feature, you find the utility of the market, of the repo market in the wider financial system decrease dramatically. So when people start to say it's a problem or it's an issue, I would challenge that. Okay. It's, to the extent that it is a problem or issue, you have to view it within the context of the tremendous benefits that collateral reuse actually brings to the market. Okay. So, but in defense of Dr. Murau, there is a researcher by the name of Singh who works at the International Monetary Fund, who is on the same page, who's basically saying collateral reuse is this big problem, right? And he did a landmark piece of research back in 2011 and introduced this concept of collateral velocity. Okay, how easily does collateral actually move through the financial system? And since then, and it was a landmark piece, excellent research, really valuable at the time. And since then, he's refreshed those numbers, he's refreshed the methodology, and he publishes that every year. And every year, that seems to get a lot of coverage, right? Gets a lot of financial press because the financial press love a good doomsday story. But what I'd like to explain to people today is that we're not in 2011 anymore. We are in 2023. We have the leverage ratio implemented for over 8 years now. We have the liquidity coverage ratio implemented for over 8 years, and the net stable funding ratio, which is the second liquidity dimension, which impacts the repo market, has been in place for 2 years now. Okay, so the regulatory environment's changed. I don't think people should be focusing on collateral reuse, given that we have so much effectively constraints on the repo market and the reuse of collateral embedded, or at least implicitly embedded within that framework. Okay, I want to talk about, actually, do you want if I move some of your slides back?
Oh, go ahead.
Yeah. So I want to go on to talk about the balance sheet methodology. So this is what I'm saying, this presentation has excellent educational value. Okay? You can't open a book and find that sort of repo treatment laid out as beautifully as the good doctor has done, right? But what I would say to that is that that is not new, right? That is how we reflect the repo and balance sheet in the financial accounts today. So if I was to open, for instance, the financial accounts of, say, HSBC or Deutsche Bank, right? I'd go to my balance sheet and I'd see on the liability side, I'd see repo, and on the asset side, I'd see reverse repo. And then I've got notes to the financial accounts. And I go to those notes to the financial accounts and I see the assets pledged, and I see the collateral received and the assets transferred. Okay, so that information is there, it's published. Even better, if I go to the Pillar 3 disclosures of banks, there is a specific disclosure called literally called the asset encumbrance disclosure, okay, which gives me a full transparency on the type of collateral either posted or received or transferred. Okay. And it tells me the type of collateral. It tells me whether I've got government bonds or corporate bonds or asset-backed securities. And it even tells me, is that HQLA or not HQLA? This is beautiful transparency. And so we have a lot of transparency in the market, which actually speaks to a lot of the transparency that Dr. Murau seems to be looking for here. Okay, and then over and above that, Mr. Vidts alluded to the fact that we have SFTR reporting now, right? On top of that, we have large exposures reporting. Okay, unfortunately, that reporting really is in the domain of the regulators, but you as academics have the best possible chance of getting access to that data and analysing that data to deliver the aims of Dr. Murau's presentation. Okay, and so as a practitioner, I'm deep in the repo markets. I've implemented the Basel Accords within a range of banks, and so for someone like me, I don't really need to understand this concept of vertical repo and horizontal repo, right? I don't need to think in those terms. And similarly with this replacement of, so I think of repo and reverse repo as two sides of the same coin. I don't need to have this additional terminology called a repo IU to kind of get to understand what's going on. Okay? But I fully appreciate that maybe in the academic world, in the academic literature, we need additional frameworks to effectively describe what's happening in the market. The only thing I would caution against that by creating additional terminology and additional nomenclature, we don't create more confusion, because as Mr. Vidts alluded to, we have enough confusion in the market about repo as it is. And we heard today there's the disconnect between the legal treatment and the accounting treatment. There is no disconnect between the legal treatment and accounting treatment. Okay, there's none. It's just people seem to think there is. There's just so much confusion in the market. I don't really know why. And maybe I'm sitting from a privileged position where, because I've had to implement the Basel Accords in banks, right? I've been in the weeds, I've been in the data, I understand the accounting treatment, end to end. That's why I don't see an issue. And I'm very wary of people potentially creating more complexity when there doesn't need to be. Okay. So, like I said, we can all agree to disagree and still have a beer at the end of the day. I think it's really valuable work that what was presented today. But let's be careful about the path we're going down, because there's a lot of credibility built around academic papers, and sometimes people reach too far to the next conclusion, such as regulatory action. And I don't want any further regulatory action in this space. We have enough regulation that we as bankers and exchange houses and clearing houses are trying to deal with, without research kind of pointing that there's problems that aren't necessarily there. Okay, but that's just my view, right? And happy to debate, happy to discuss. Yeah, that's really my practitioner's view. And maybe if you had a regulator in front of you, you might have a very different view. So thank you very much.
Thank you, Clive. We had a conversation, but I thought we were not maybe it's not right now. But if not, then that's for the intervention. And now we maybe keep Steffen an opportunity to respond, and then open it up to the floor.
Yes, thank you very much. So I come to the front, Mr. Here.
Come to the front, why not? The great guy, Jeff. Yes,
well, thanks. Thanks a lot for reading it. And so you're both very critical, which I find interesting and instructive. I guess from my point of view, this paper does not have such a normative ambition to say that it's necessarily bad, right? So I mean, I guess the ambition is really to understand how can we conceptually make sense of the reviews, right? And how can we be intellectually sound and really deal with, I don't know, for me, it's still a puzzle what it means. So in terms of balance sheet, when the collateral is encumbered, right? So in particular, what does it mean on the counterparty balance sheet? So how can we think of this? And we also found reportings of banks where they then in a footnote basically treat the encumbered security as off balance sheet on their balance sheet, right? So that's why we feel that what we write in there, yeah, I totally buy it. So I mean, maybe it's even the best confirmation of the paper that's many of these things you find trivial, right? So I would I would be most interested in when we don't talk about normative questions like should repos exist as a redo is bad, because so to me this is not our concern here, right? It's the conceptualization of the instrument in a like intellectually sound and consistent framework that can be scaled up to describe the entire system, right? And to get things right. And I still would really like to understand where the disagreement lies. So, I mean, maybe to Clive, so you say you don't need the distinction between horizontal and vertical, but does it mean that it's the same for you? Because the argument is that, so one comes with additional reserve creation and the other one doesn't. So is this something that you agree or disagree with just on a factual level?
So as a practitioner, I don't need to see the distinction to understand central bank repo to bank repo and to bank repo. And a key piece that's missing on there, which I actually was going to ask, is dealing with client repo. Okay, critical piece of the market structure, where it's not in the framework there. But so, like I say, maybe for academic purposes and for the audience that you're writing to, you do need to make that decision. But to me, it just it doesn't add anything. It doesn't add any
because you don't care about the question whether the reserves are being created or.
I do care about it. It's just I don't need to have labels like that.
Okay, but so you would say it adds a layer of complexity that is needed, not needed, but you would not disagree with the distinction that those are at least two different operations on the repo lender side.
They're absolutely different operations.
Okay.
I'm just weary that by calling something horizontal and vertical, you're adding a layer of complexity which doesn't need to be there, and most importantly, you're missing the deal with client repo dimension.
Okay, thank you. Then I understand the criticism.
So it's normal practice, but it's not yours, it's kind of a guarantee. So it's only becomes yours when the public party goes bust, and then you have to take hold on the balance sheet, the action underlying collective that they have faced. So that's where the confusion is. And I think in the parliament we have 15 people and 50 euro and 50 euro in the hour. You never read from the 50 euros, which is the same number from the bill that we had before. No? So reuse is acceptable in cash, and it's just the same in forever. You reuse it for the purpose of having a guarantee against the pleasure. Reuse is 99% of the law. It's not reuse, it's called re-application in the states. They have a complete.
Yeah, but that's what you say. So, but our idea is that if you try to put it on balance sheet, so if you try to put it on balance sheet, reuse and reapplication is the same thing, right? The question is, it's not.
It's totally different.
Yeah. So to give you an example, if as soon as you reuse the collateral, right, the cash, that cash goes on the balance sheet, does it not? It goes on the balance sheet as a liability. So where's the missing piece of the puzzle? That's what I'm not getting. Right. So I get so somebody has given me collateral, right? And I can sit on that collateral and do nothing, or I can reuse that collateral. The moment I reuse that collateral for cash, to borrow more cash, that goes as a liability, that cash goes as a liability on the balance sheet, and the cash goes as an asset on my balance sheet. So we've said cash goes as an asset on my balance sheet. Okay. So it's not as if reuse collateral creates some mysterious way to take more leverage, right? As soon as that collateral is reused, the cash that comes into the bank goes on its balance sheet.
So when you said about the criticism about the first balance sheet was that it was correct but trivial, but then here you would say this is clearly a wrong depiction of what reuse means in this balance sheet example.
That is perfectly accurate. Right?
Okay.
What I'm saying is reuse is not this big major issue anymore. Right? It was when we didn't have regulatory requirements like leverage.
But this is again where I say I'm not saying that this is bad, good or bad. I'm not normative here, right? I just try to develop a consistent notation style, sure. And if it's only to be able to for the educational values that you at least acknowledge, right? So
this is a fantastic education value.
Okay, so you don't. Okay, so that means you do not disagree with this notation style.
And then it's, well, it depends how far you want to take it. If you are going to force the banks to suddenly disclose their balance sheet in the way you've done, yes, I do have a problem. Right? Because that information is already in the notes to the accounts. You want to display it on the balance sheet itself with front and center, right? And I personally don't see the need.
Okay, well, that's understood.
You want to push it further? Are you okay with
No, I mean, I'm just trying to understand the criticism, and I guess that we're just very orthogonal views on what this actually is, right? But yeah.
Just a few comments, right, to short. I find it very instructive, very useful, and happy that you're pushing this. It's been a question of mine for a while. Couple of things. I think the reuse part is interesting because the real issue is in the sense that we talk about liabilities here, it is like a kind of a meta liability, right? It's a liability that becomes then a liability that involves a third party, right? That is getting the collateral in order to lend to the previous lender, right? To the first party. So there, I think it's a question of how this notation should look. And I'm wondering one thing, Steffen, or two things. One, in the just initial notation, could we not simply split it and say money on the one side is assets and IOU for returning the money on the liability side, where the counterparty gets the claim on the money and the IOU for the security that it holds, right? Just a simple full split of like having multiple entries to represent the whole thing. So that's one thing. Another that I've been also struggling with how hypothecation would look. Would it be maybe useful to have the security depository institution where the security is, and then so we can just trace the transfer of security through the rehypothecation chain, right? And just kind of move it from the account of one to the account of the other to the account of the third entity, maybe is a solution. Another two kind of orthogonal questions here is the three-party repo. How would that look? Would that be interesting to represent here somehow add to the notation? And just I want to quickly just talking on the coming from like money view friendly legal theory of finance, we think of finance as the legal creation. It has a legislative action with science, right, which is a public purpose, right? And from that point of view, the question is what collateralizing means for us, right? For us, it means a form of insurance, right? And what should be good about collateralizing thing is that we hedge a certain amount of risk by introducing the collateral into the picture. And from some work that we have been doing on China's interbank market, which is fully repo, right? There is no uncollateralized interbank market. Bank contagion works very differently if you have security as collateral, right? And there, the repo is pledged, which means that you cannot lose, right? And that really makes this market very robust and makes it very, very hard to get into engagement. But if you could have the same piece of security move and become collateral for multiple lending operations, basically, if something happens to the collateral, if there's a shock to the collateral itself, rather than to the borrower or whatever, you have a problem, right? Because all of these entities get margin calls immediately on the same, because the same collateral is different. To destabilize the market, potentially push some of these borrowers into bankruptcy and right? So there, the collateralization as a type of insurance, the reuse becomes put into question, right? That would be the reason why reuse could be a negative. It is surely creating additional liquidity, but it's creating the wheels, and that's a nice thing. So we want to raise the wheels and keep the kind of tension capacities according to collateralization. Are we using that capacity in this way? I don't know. Potentially. Correct.
So yeah, like on the data question, I agree with Clive that the data are there. Like maybe the problem is for you that you look at Europe and you know the bank balance sheet data is woefully lacking when you compare it to the call reports. But if you look at the call reports in the US, you have all of this data. It's there. And I would like to also push back a bit on this disappears in an off-balance sheet item, because I think the smoking gun evidence that this is on the balance sheet is, just look at window dressing. And I know you are familiar with my work on that. If it wouldn't be on the balance sheet, then we would not see repo window dressing, which we have seen, when the leverage ratio disclosure requirement went into effect in 2015. Massive amounts of money with lots of repercussions. So they were doing it precisely because it was biting. So that's one. At the same time, I would like to push back a bit against the example on cash, because it's not the same when you use a 50 euro bill again, because with the repo, if you rehypothecate, you leverage, right? And again, the proof that you leverage is because your leverage ratio increases, and then it bites you when it comes to how much capital you need to.
That's the point I'm making.
Yeah.
So, it's sorry if your leverage ratio is unaffected with really these collateral, it's absolutely.
Yeah.
And that's the control we as a financial system have in place to stop effectively with the users.
Yeah, no, I agree. I'm just pushing back against, the analogy with cash that, you can just use cash. It's the same. It's not the same because one gives you leverage, the other one does not. So I just want to clarify the difference. And then another one is just a question for Steffen. How would you think in terms of this vertical, horizontal? What would be like, how would the MMF sector fit in there? I mean, the repos with banks are massive, but I assume they are vertical for you. And then what do you think about the reverse repo facility? Something that you jumps 2 layers of the hierarchy and goes on the other side of the balance sheet?
Don't forget that the bank also using other currency.
Yeah, you can. I mean, this is now a national story, basically, right? Still within a national hierarchy of money, which is like a underlying concept, but then you can try to extend it internationally. So I would need to think about it, how to integrate this. That's a lot of it.
CSZ is only machine that transmits the data.
No, for sure. It's just for the notation purpose, because you keep it from the same balance sheet.
Sasha, maybe you can be afterwards and give you a chance to respond to any.
Yes, no, I mean, a lot of great input. I will also be happy to look at the video and think about individual points better. Maybe just as a final thought, well, academia is all about disagreeing, right? So disagreement is seen as something very productive, and yeah, so just thanks a lot for reading it and for taking the time to comment. I appreciate it a lot. Thanks.
So I hand over to Adam. Maybe at one part and close the session. We need a lot of fields. Sorry.
Okay, so we are behind schedule actually, and my housekeeping note is that thank you everybody for attending this all-day event, and as you